Good afternoon, everyone. This is Anthony Alaka with Torrey Hills Capital, and welcome to the Millennial Precious Metals webcast for April 13th, 2022. I hope everyone's doing well. Thanks for taking the time to join our virtual lunch today. We are very excited to bring you Millennial Precious Metals today. They are a Nevada-based exploration company with 7 properties in Nevada and a newly acquired property in Arizona. The company is starting an aggressive drill program at its key assets with an expected PEA later this year. We feel that the company is well positioned to be a 1 million ounce plus producer. The company trades on the OTC market under the ticker MLPMF and on the TSX Venture under the ticker MPM. It's currently trading at 42 cents per share US, representing a market cap of only $75 million. The company has a very strong balance sheet, high percentage of institutional ownership, and is trading at a discount to its peers. So we feel there's plenty of upside in the stock as the company continues to execute its strategy. And based on the current outlook for higher inflation in the US, gold prices are expected to move higher, making precious metal stocks very attractive at this point. I think you just heard our conversation. The exploration companies usually lag. We feel that Millennial Precious Metals is well positioned to benefit from the positive outlook for the space, and that this is a very good entry point here to really take a look at the company. With us today to discuss Millennial Precious Metals and operations and the growth strategy going forward is the company's president and CEO, Jason Kosec, and the company's vice president of corporate development, Jason Banducci. It's great to have you both on today, and thanks for taking the time to bring our viewers up to speed on Millennial Precious Metals. Obviously, a lot of exciting developments are happening with the company and the sector, and I'm excited for you to share those with the group today. Just before we get started, I want to mention if our viewers have any questions during the presentation, simply type your question into the Q&A or chat box. It's probably the easiest way to ask, and we'll make sure that all your questions get answered. So with that said, I'm going to turn it over to Jason Kosec. Jason, the floor is yours.
Thanks a lot, Anthony, and thanks for all your listeners for joining in today. Really much appreciated. I'll start you off with a little background on how the company became to be, run you through all of the assets, and then really the value proposition that Millennial has to offer today at this time. I myself come from the Talisker Group, and we did all the technical due diligence for all Osisko related companies. But then went out on our own to form 3 companies. One, Talisker Exploration, which is focused on British Columbia, Sable Resources, which is focused on Latin America, and Millennial is our vehicle focusing on the Southwest US. Unlike most companies, that is a rebrand of a previous company. This is a fresh story. None of these projects have been in the public domain for over a decade. We did over 337 desktop reviews, 47 site visits to really build this diversified portfolio of assets that we will talk about today. What we're doing here is building a multi-million ounce, multi-asset production company. And what we were looking at in the asset selection criteria is looking at assets on a development stage that had clear visibility of 1 million ounces of oxide, that had a unique combination of grade to strip ratio, which we'll touch on later in the presentation, that really drives the economics. And really wanted to focus on really Nevada and Arizona as it's the top mining jurisdiction in the world. One of the things too we wanted to look at is what people neglect to acknowledge is that we wanted to look at projects that had a low cost per discoverable ounce. And what I mean by that is how much does it take to drill off 1 million ounces? And these types of systems, it takes, $7 to $10 million. So really low capital intensity to drive value. In other types of projects that you see in Canada, in higher grade vein systems, to put it in perspective, for 1 million ounces, it can cost you $40 to $60 million in drilling. And as a shareholder and as one of the major shareholders of the company, people think that drilling is a sunk cost, and it is not. Shareholders need that value back. So we wanted to look at projects that had low cost per discoverable ounce, and also are low in capital intensity when you try and put them into production. So put that in perspective, these projects we could build for 130, 150, as opposed to sulfide projects, which cost, 500, sometimes upwards of $1 billion. What you get at the end of the day with Millennial is really between my two partners, Terry and Ruben. We've done this 7 times. We've put up over 59 million ounces of discoveries. And of those 7 projects, 5 of them are in construction or in production today. We've built a very diversified portfolio, 8 assets. Today, we'll focus on Mountainview and Wildcat, which are development stage assets that host the 1.2 million ounces of oxide and will take the brunt of the 20,000 meters of drilling. Mountainview and Wildcat will have an updated resource in the 3rd quarter of 2022 and a joint PEA in the 4th quarter of 2022. Red Canyon, we'll touch on it a little bit today. It's a very exciting exploration story. It's right in the heart of the Battle Mountain Eureka Trend, 35 kilometers outside of the Cortez complex, which has produced over 55 million ounces of gold. It sits in the same rocks, it sits on the same fault system, and it's the same age of mineralization. So all the key criteria that you want to look at, you really get it there for Carlin style systems. Dune, Eden, Mar, Oslo, and Sierra Colorado in Arizona, that's not on this map, are really part of our organic growth pipeline. So what we like to say is, after the drilling program at Mountainview and Wildcat, you get a significant re-rating opportunity off those 2 assets to trade in line with our peer group. And then the rest of the portfolio you basically get for free and is your blue sky in your free carry that you commonly don't get in a developer. To my 2 partners, Ruben and Terry, both PhD geologists. They're head geos at Anglo Gold Ashanti, where they discovered Las Colossus and Gramalote, and at BHP, where they found Escondida East, which is over 1.5 billion pounds of copper. Mike Leskovic is a partner in a fund here called Northfield Capital. Sarah Hessen used to run the ASA fund, which is a division of the Oppenheimer family. She is now a business professor at Stanford. Eric Tremblay is the CEO of Dalradian and built Canadian Malartic, Canada's largest gold mine. I myself, I'm a structural geologist by trade. Started off at Côté Gold, which is now put the first holes in 2009. We sold it to IAMGOLD for $680 million. It is now Canada's 3rd largest gold project. From that, I then went and joined the Talisker Group, where we put the model together for Windfall, which is now over 7 million ounces, and Barkerville, which is now over 7 million ounces. Raphael Dutot is another PhD geologist. His specialty is in geostatistics in resource optimization. He was with IAMGOLD as well. And I'll let Jason Banducci, who's also on the line, introduce himself now.
Thanks, Jay. So my background's on the capital markets and finance side. I spent the last 8 years of my career on the banking side, the last 5 of which in mining investment banking for GMP Securities and then Stifel. I've sat on your side of the table as investors and potential investors. I've been pitched by a lot of mining companies in my career, and this was one that caught my eye and eventually led to a career change. In this sector, there's not too many companies that I think offer the same combination of high quality assets and a management team that's done this 7 times before. For me, I wouldn't have jumped ship from a banking job to a junior explorer unless I thought, these assets are actually going to be a mine one day. And here, I think we have a portfolio that sets us apart from our peers.
Thanks. Quickly, from a share structure point of view, we went public at 50 cents in May of 2021. We raised part of the sub-receipt financing we did in January of 2021. We raised $24 million straight common, no warrant. The warrants that were attached were broker warrants with a 2-year ticket on them. Cash balance is closer to $10 million right now. I think one of the things that sets us apart from our peer group is when you look at our share roster, you commonly do not see this type of institutional ownership. Merck is a division of the Oppenheimer family. Eric Sprott is Eric himself. Vescor is a $20 billion pension fund out of Halifax. NewGen is a multi-billion-dollar fund here in Toronto. Franklin Templeton, who I'm sure most of you know, out of San Francisco. Century is a multi-billion-dollar fund here in Toronto, and Broma is the Lundin family office. So we're 50% institutionally held, very tight retail float at 26.5. Insider ownership closer to 11.5%. You know, I myself, I'm a young millennial. I'm not Richard Warwick. I can't write $100 million checks. But I myself, I'm the largest individual shareholder other than Eric Sprott. I put over $625,000 of my own money into it. The last money I put in, I bought it, stock, I believe at 65 cents. I put in $12,000 there as well, and consistently buy in the market when we are not in blackout. As I mentioned, this is a fresh story, and it's very rare to see 5 brokers already covering us from target prices from 90 cents to $1.40. And what you're really modeling here is something that could be producing, 125,000 ounces per annum with an all-in sustaining cash costs of around $950 an ounce. CapEx number 130 to 150. So looking at something that could be, $350 to $400 million NAV, and then these guys put a 0.5, 0.4 multiple to NAV into their model to develop their target price. We'll go along, why these guys put money in now is because we're trading at 0.2 times NAV. And we have to do the systematic work to de-risk and add ounces to get that significant re-rating opportunity as we do that. And we'll talk about the value proposition later on in the presentation.
Jay, just going to jump in just quick. So if you flip back and you look at where the analysts have us from a target price perspective, right now we're sitting at 52 cents we're currently trading at. And if you look at where the analyst target prices are, again, from 90 cents Canadian up to $1.40, the value that these analysts are ascribing is primarily with respect to Wildcat and Mountainview, and that's only 2 out of our 8 assets. So the way we like to present the value proposition to investors like you is like you've got to you've got to double or triple based on the current price of the market right now, and that's just on Wildcat and Mountainview. That doesn't include Red Canyon, Dune, Eden, Ocelot, Mar, and Cerro Colorado. So there's a whole lot of free carry and additional optionality you get as part of the portfolio, and essentially you get that all for free.
Yeah, good point. Thanks. I think it's very important as we build our brand as Millennial. In the previous generation didn't do that, and as we build the next mining house, it's important to know that mining can be done in an environmentally and socially sustainable manner. It's a key pillar to our society, and frankly, we're educating also, you guys now and the next generation that the eggs don't come from the fridge, and we need mining in our society. I'm going to get into the assets now. As a geologist, I'll keep it high level. So if anyone has any technical questions that wants to talk about the kinematics and alteration signatures of low sulfidation epithermals, I'll be gladly to go into detail. But really, I'll focus on the value proposition and really the growth that we really see over the next year to 18 months. Right now, we run our resources very conservatively at $1,500 gold. So, even if we run them at 17, there's 824,000 ounces sitting there right now. Okay. What we really like is these are pit constrained ounces. So like I said, we run them at a $1,500 gold price, $2 a ton mining, 4 processing, 2 G&A. So very conservative operating numbers. Grade sits at 0.4. And the key metric here is that there's no strip. And then later on, I'll get into really what drives the economics. Everyone thinks grade is king. Grade is not king. Mining is like any other business in the world, and it just comes down to margin. And really, we'll show you where the growth potential is. This program at Wildcat is 40 holes, 6,000 meters. We are just starting the program at the end of this month. What it is designed to do is to do the geotechnical work, so how steep you can make your pit walls, understand the leach kinetics and the metallurgy, see where the resource is open, see where the resource is closed off, because it's not open in every direction. And very important to see what the resource conversion rate is. And what that is as you de-risk it, how many ounces go from inferred to indicated to measured, and how many ounces do you lose? It's very important to see that when we push forward. And this program will feed an updated resource in the third quarter, and that resource will be the base for the economic study that will give us that re-rating opportunity from where we're trading at 0.2 times NAV to trade in line with our peer group at 0.4 times NAV. As you can see, the current pit shell is this red line and above. All of these blocks are not in the current resource. So there's significant growth potential. All these yellow holes are planned holes, so they could fill in big gaps in the block model, okay? The current program, it's important to note, there's 2 types of permits that you receive in Nevada for exploration. There's a notice of intent permit. We can get into more detail on them, but what the NOI gives you is 5 acres of disturbance. And here lies the opportunity, is that what we do as Talisker, we look at projects that, did the previous geologist forget to do something? Did they use the wrong geological model? Or was there a gap in the claim block? Or did they have the wrong permit in place? And these assets came from a company called Allied Nevada that was going bankrupt because of another mine they were trying to put in production, which was Hycroft. So they didn't have the financial capacity or the intellectual capacity to proper evaluate what was there. Then they went into, after they went in bankruptcy, they went into a company called Waterton, which is a private equity, $2 billion private equity fund, and they did nothing with it. And where we really see this going and where we drive value is because they were confined to a certain permit, they couldn't drill off anything outside of this current resource. And where we see a lot of growth potential is areas outside the resource and in these gap zones. So what does that mean we'll have a bigger program in 2023, but what we're really looking at is something that's 2.3 kilometers by 1.2 kilometers by 150 meters. If you use 2.7 for density, okay, and say 30% of that is mineralized, you're looking at over 200 million tons, okay? And we currently sit at 62 million tons. So the growth potential here is significant. It should be noted that there is, in the 1900s, there was 24 historical mines within our claim package, okay, which is over 14,000 hectares right now. We are only looking at 6 of those current historical workings in our current resource. So, like I said, not only do you get a re-rate off the current drill program and the economic study, but over the coming years, we could systematically add economic tons to really drive the value proposition out of brownfields growth. We just recently significantly increased our land position at Wildcat by 87%. So we're currently, that's the current resource right there. There's a lot of historical work that sits outside. There's over, like I said, multiple historical operations that don't sit inside there. Our job as a management team is to look 3 years, 5 years down the road. So we've secured all of this land package to the northeast for leach pads, for haulage routes, for the major highway that comes right through the property. The power line comes right through, and the haulage is much easier to go down the mountain with electric trucks. So the trucks, when they're loaded, they go down the hill, they charge the battery, they dump, and then they come up empty. So you're not susceptible to higher gasoline prices. So these projects are open pit oxide projects, are the least susceptible to inflation. Okay. Mountain View is a project that we're drilling currently. Like I said, right now we use a $1,500 pit shell, so very, very conservative. $2 a ton mining, 4 processing, 2 G&A, 45-degree pit walls, 80% recovery. Average recovery in Nevada is around 75%. Currently sitting at 427,000 ounces. Grade is significantly higher at 0.57. I should just note to everyone out there, and we'll get into it later on, the average grade of the Great Basin, so primarily Nevada, Idaho, Utah, Arizona, is 0.38. Okay, so these are quality ounces in the best mining jurisdiction in the world. Also to note that the PEA will be a joint PEA, as I mentioned, between Wildcat and Mountainview. They'll have their own separate pits, pads, and ponds. But what you'll do is you'll truck the loaded carbon, so a very, very concentrated gold solution, to a centralized stripping facility. So you save significantly on your G&A, and you save significantly on your CapEx because you only have one stripping facility. What the program was designed to do was to understand the rock mechanics, so the geotech, to do the pit walls, understand the metallurgy on the leach kinetics, see where the resource is open, see where it's closed off. The program will finish at the end of the month. We have one more batch of holes that look very, very interesting that will release at the end of the month. It was 29 holes, almost 7,000 meters. What we've noticed is the grade is higher than expected in the block model. The way these systems form, think about them as a mushroom. The fluid migrates up vertically up the stem, which is your bonanza grade feeder zone, hits a more permeable horizon, and that's in your disseminated zone. So the discovery of the feeder zone, I'm talking almost a meter of 141 grams, comes from that stem. So there's significant growth at depth as well that has never been discovered. Okay. Also, the yellow material that you see here that sits above the resource is composed of sand and gravel. And why that's significant is when you go into a mining scenario, it won't be a conventional drill and blast. It's what we call free digging. So you can dig it out with a hoe and a dozer. So your mining costs aren't going to be $2. They'll probably be around $1.50. Okay. The oxidation profile is extremely deep, so really good for leach kinetics. It's really broken up, so it reduces on your CapEx on how much you have to crush the rock. But the most significant thing is the grade continuity. 120 meters of 1.73 gram oxide. As I mentioned, the average grade in the basin is 0.38. So significantly higher than the average. What we see is the grade gets higher at depth and into the basin. Okay. More results that we put out, 275 meters of 0.5, 189 of 0.46, 232 of 0.9. So what the program and what I'm trying to get at is what you mean from inferred to indicated. It comes down to drill spacing and how certain you are. So right now, we have a hole like this and a hole like this, and this distance is 100 meters. So you're asking the geologist to, what is the certainty between those two holes? In order to increase the certainty, we as a team have to put a hole right in the middle to see if the grade in this hole was the same as the grade in this hole. And we're seeing the grade is higher, is 10% higher. So the blocks are converting very well. And we're infilling gaps in the block model that can add quality tons within the existing resource base. And again, these are pit constrained. So this black line you see here in these red lines I'm drawing, everything above that is in the resource. So all of these blocks that sit outside are not in the current resource. So there's significant growth potential. Again, Wildcat and Mountainview are the same type of deposit. They're low sulfidation epithermals. They formed around 14 to 16 million years ago. I'll get a little bit technical here because I think it's very important to understand that, this is how we drive value, is our intellectual knowledge in understanding these systems. What we see is how these things form is they form along these major faults. So this major black line that I've retraced in red. And what happens is the fluid migrates up these faults and hits these more permeable horizons that you see, these rhyolites that I've just circled. And when you go from compressional tectonics to extensional tectonics, you remove lithostatic pressure, you create flash boiling, and you cause the gold to drop out. And why is this important is that we see where these dilational jogs are, these bends in the faults. We see historical high-grade workings in the footwall. So we're only looking at this one mineralized zone. So to see two more mineralized centers along this fault system is highly probable. And this is exactly what you see in the Sierra Massif and the Sierra Madre. Not only do you see that up in the upper system, in the cap of the mushroom, but the veins develop in the basement, and they develop in these more robust rocks called andesites in the basalts, where they can actually crack open and develop a vein. And that's where that, a meter of 141 grams comes from. And, a very analogous deposit is the Sleeper deposit, which is around 3 million ounces. And, we're at 500,000 ounces right here. So again, we like these projects because they didn't have the proper permits. They didn't understand the geology. So now we understand the geology. We'll obtain the proper permit. So the growth potential at both Wildcat and Mountain View is significant over the coming months and years. Again, the blue is what we originally had, and the green is what we've gone out and staked. This is the major road and power line. So securing access to the highway, to the power line, and all of those higher grade old workings that sit outside of our claim block, we've acquired them as well. These are nice, desolate areas, great for mining, no people. This is the actual highway right there. You can see the power line right here. So, connection to grid power, connection to the highway, no people, no trees. It's great to work in this environment as opposed to up in Canada, where you're up on a mountain with a beautiful glacier, indigenous groups, salmon spawning rivers. You don't get that here in Nevada. I'm just going to touch on one of our exploration projects. And as Jason Banducci mentioned, Wildcat and Mountainview, as we execute this program and do the PEA, you will get a bump from 0.2 times NAV to 0.5 times NAV as we de-risk and add ounces. So that's your 2 to 3 times lift just on those 2 projects. So Red Canyon and the rest of the portfolio is basically your free carry in your blue sky. We drilled this right when we went public. Some of the most significant results I've seen, I'm talking, 54 meters of 4.5 gram oxide from surface. Remember, this is 35 kilometers south of Barrick's biggest project, Cortez Complex, sits in the same rocks, same age of mineralization. So just so everyone knows, that age of mineralization for Carlin is between 30 and 40 million years. This sits at 35.5. So right at the peak of mineralization. So all the key exploration criteria to host these massive mines that you see in Nevada, this checks the box. And just so everyone understands, Nevada, if it was a country, would be the 5th largest gold producer in the world. Carlin style systems like this, like Red Canyon, has produced over 222 million ounces. So these projects, these types of deposits can be 10, 20 million ounce deposits. And that's what gets us excited. And these are the types of things that you don't pay for right now in the company, because the market gives you no value for. I think this is really what sets us apart, other than the obviously the team that we've done this 7 times. We've done it, put up 60 million ounces, the institutional ownership, but most importantly is the quality of these ounces. And way you need to look at projects that drive the economics so you can understand the margin. This is the way Barrick looks at them, Kinross and Oceana and Anglo, is you need to do the grade divided by this strip to get the effective grade of the drives your margin. When you do that, Millennial has the highest effective open pit oxide project in the best mining jurisdiction in the world. Okay. Everyone thinks GSV, which is a $250 million at 0.77 is high grade. The reality is, when you factor in the strip, so the strip is how much waste rock to ore. Okay. When you factor in the strip, the grade actually sits at 0.19, whereas we sit at 0.42. Okay. There's a severe scarcity of these assets. Hasbrook is 50% owned by Sun Valley, so it's a private equity firm. So it's basically a private company. Northern Bullfrog has been gone. Gold Rock, these are all been gone in recent transactions. Pan has been gone. These are owned by major companies. Mother Lode has been taken out. GSB sits at 1.3 million ounces in their pre-feasibility study. So they've done their economic study. So that's why they trade at 0.5 times NAV. And that's why they're 250 million. And that's why we're not there yet, because we need to do the engineering work. And that's really the value proposition that you see today. Quickly, what I wanted to show you is, again, mining is like any other business in the world. So what we've done here is the strip adjusted in situ value. So how much is the rock worth in the ground? At $1,600, that value of the rock is $22. Our cost is $11. So you're looking at a 50% margin at $1,600 gold. Apple doesn't make a 50% margin, okay? At $2,000 gold, we're at 1980 today. You're at a 60% margin. So, you can't always focus on grade. There's a lot of other things that go into the economics. And like I said, these are the highest margin ounces in the best mining jurisdiction. Okay. So where do we see this going? Right now we sit at 1.2 million ounces. We have clear visibility to grow it to 1.5 million ounces of oxide. With the sulfides, we could probably push it closer to 2. You should note that GSV sits at 2.7, but of that 2.7, it's only 1.3 of oxide. So that it's only 1.3 million ounces that's in their economic study. Okay. So that's what gives them value at $200 million. So on an EV ounce basis, they're actually trading at $100 on an EV ounce basis. In the recent acquisitions in Nevada, the ounces were acquired between $100 and $150 an ounce, and we currently sit at $40 an ounce. So there's a significant re-rating opportunity to trade in line with GSV and Liberty as we de-risk them and as we do the engineering studies and as we do the updated resource. So in the next, once the PEA comes out, that's why I'm a smart one now when we're trading at 0.2, 0.18 times NAV, because we've done this multiple times. They will get that re-rate once we put out the PEA in the fourth quarter. One thing to note is, and people forget it, is that time will kill junior companies. And basically when we put out the PEA in the fourth quarter, remember we've been public since May of 2021. And since that, and until the PEA, we'll have gone public on 2 exchanges. We've raised $24 million. We've drilled 20,000 meters. We've acquired 8 projects. We'll have done 4 resource estimates and a PEA, and like I said, drilled 20,000 meters. I beg to differ. There is another junior company out there that has done that in 18 months of being in existence. So what I want to get at is it's a catalyst-rich story with a very tight float and the cash to execute everything on this list. You'll see another batch of results coming from Mountain View at the end of the month. Then you'll see drill results from Wildcat as we'll initiate that program at the end of this month. You'll see an updated resource, and really the big value driver is the economic study, which will bump you from 0.2 to 0.5 in line with our peer group. So to wrap it all up, you've got a team that's put up over 60 million ounces, done this 7 times. It's literally, everyone says tier 1 mining jurisdiction. Nevada, under the Fraser Institute, is #1 in the world. Why? Because of permitting and the metal endowment. Like I said, it's the 5th largest gold producer in the world. It's one of the richest piece of the Earth's crust for gold mineralization. You have a significant resource base that we can add ounces very cheaply, and they're very cheap to put them in production to compare to other types of projects. You have a world-class institutional share roster, significant insider ownership that keeps continuing to buy in the market when we're not in blackout, and are really driven by a catalyst story, driven by the drill bit, and then wrapped up with the economic study to drive home the real value that we will unlock for all of our shareholders. And with that, I'll open it up for questions. I think we got about 20 minutes for that.
Yep. Thank you, Jason. Obviously, so many, if you look at the investment highlight slide, right in front of us now, there are so many catalysts to get involved in the stock now. To our viewers, I mean, you have an opportunity to own the stock below what management has purchased in the open market. And so this is clearly a management team that has not only accomplished a lot in a short period of time, but they've put their money where their mouth is in terms of investing in it personally. And I've been doing this for a while, and I have yet to see a company with a market cap of under $100 million have that kind of institutional ownership. So I think it's definitely a compelling story. And if you look at what gold is doing right now and the outlook for gold overall, we feel, we don't give stock advice here at Torrey Hills, but we would not be representing a company that we didn't feel was a good investment for our investor base. So keep that in mind. At this time, I do want to open the floor to questions from our attendees. If you have a question, type it into the Q&A box. We'll need a moment to queue up a few questions. In the meantime, I do want to focus. I know you touched base on it, Jason. The jurisdiction is amazing. I mean, we're seeing what's happening in Chile with their just proposed some crazy royalty tax that they want to do, and and everything that's going on geopolitically. This is clearly the best jurisdiction in terms of stability and in terms of obviously resources around the resource that you guys have nothing to worry about in terms of power, water, things that you run into in other countries.
And permitting and taxes and everything else you want to be thinking about from a shareholder perspective. And, you can see it in some of the M&A activity recently, right? In the last year, there's several new entrants to the Nevada mining market that have never historically owned or operated mines. You look at Caliber Mining, which bought Fiore, looking to diversify away from Nicaragua. Same thing with Centerra buying Goldfields, right? This is as crazy as the world continues to get. People, including mining companies and investors, just want to reduce their exposure to certain parts of the world where, again, you just have less control over both the political environment, taxes, permitting. The world's crazy enough as it is. If you're going to buy a mining company, do it in Nevada.
Yeah, absolutely.
I think the most important thing for all you listeners out there, the reality is 50% of the reason why mines do not go into production is not because of economics. It's because of geopolitical, environmental, and really permitting. So Nevada being number one in the world, all of those major risks are removed. So if I can remove 50% of my risk, to pay a 10% premium to enter, that's a trade I'll take all day to instantly remove that risk, right?
Absolutely. And that's why, this makes it an even more compelling story compared to, some of the explorers. We do look at it. We do talk to a lot of exploration companies at Torrey Hills Capital, and I have to, say that we turn a lot of companies away because we don't see, they don't check all the boxes for us like Millennial does. So, really, it's a compelling story, and I think that people really need to take a long, hard look, especially if you want to play, gold. And the explorers are always, the last to make a run, and the prices have been really depressed here. And I think, you have this re-rating probably, when the PEA comes out, it's a great opportunity to get involved before that. We do have a question in the chat. Will you run the company as a prospect generator?
No. Prospect generators are great, but you give away so much value to whoever you're going to JV or option it to. We have the technical and financial capacity to do this ourselves, and we have a share roster that is very supportive on developing these projects. You know, one reason why junior companies don't re-rate once they do their economic study is, you know, you're $100 million, $200 million company, but the capex to put them into production is, you know, 500 to $1 billion. So you have this huge burden sitting on top of your head that, you know, you gotta either take on debt or issue equity. So you get diluted to oblivion. These are unique projects, and they were selected for this exact reason, is that they can be drilled off cheaply. So minimal dilution from an exploration perspective, but from a capex perspective, they're very fundable. It's not a $500 million build, it's 130, 150. So to run it as a prospect generator, you know, you just give away too much value too early on is what happens. You know, our company in Latin America, Sable, you know, that's a hybrid prospect generator. We have JVs with South 32, but those are massive projects. They're, you know, big copper porphyry things. You know, we have over 1.5 million hectares of land. You know, it's too big for a junior company to do. So you just would dilute yourself to oblivion. We're here, we don't have to run it like that because they're very easy to drill off and to build.
Yeah, very manageable products. And I think Jason Banducci made a great point earlier, is that, you know, we're looking at Mountain View and Wildcat, and you know, there's so much value there. And you take a look at what's right next to it in terms of Dune, Eden, Myron Ocelot. I mean, you have in Red Canyon and the property in
it's a real portfolio, right?
Yep.
We're trying to run this. We're not trying to be a junior exploration company, right? We're trying to be a multi-million ounce, multi-asset production company. And the way you do that is the same way you invest, is diversification. And we've got Mountain View and Wildcat, which are sort of at the front of the line, which we think we can move towards a production decision the quickest. But again, in the background, we also have Dune, Eden, Mar, Ocelot, and Red Canyon, which only take up about 10% of the budget, but we're still continuing to execute and advance those projects as well. And, you know, it's great from a diversification standpoint because they're probably all not going to make it, but there's a good chance a couple of them will. And then it's also great from a news flow to the market perspective, because we're never going to have that lag. Because if we see, you know, a delay at one project, we can quickly pivot, shift our focus on another project that's earlier stage, look at target generation, mapping. We have a portfolio that provides us flexibility in how we advance the company.
Yeah, the other thing too is, you know, the way you really build a real mining company, and the way Mark Bristow does it when he was with Randgold and now with Barrick, you know, Clive Johnson when he Bema and then now B2 Gold. You build companies that in any metal environment, you make money. I think the days of going back to $1,600 gold are over. But the reality is, even at $1,600, we still have a 50% margin. Okay. So when Clive started B2, he had this exact same principle. You know, I look up to Clive. He's one of the best operators out there. You know, since inception of that company, I believe 8 years ago, they are up 1,600%. Okay. Yeah, they're in production now, but they've had to go through this same thing that we're doing right now. But you have the foundation of the company has to make it in any environment. And then when you get great prices like this, you just get added torque. That's all it is. And that's how you build a real company. And that's what we're doing.
Yeah, and those margins are very, very impressive, for sure. Another question in the chat, which we usually talk about every time we get on, it's just kind of the ownership structure, royalties on the properties, et cetera.
Yeah, so we're very lucky that all of these assets have a low royalty burden. The highest one is at Mountain View at 3.5%. Wildcat is at 1.9%. So anywhere in Nevada, if you're under 5, that's good. You know, Red Canyon only has a 2%, and we have the right to buy back 1% for 1.5 million. Dune, Eden Bar, Oslo all have a 2%. We have a right to buy back 1% for 1.5. Same with Sierra Colorado. So very, very low royalty burden. And you know, from an ownership perspective, like I said, I'm at 7.6%, I believe. Like I said, I've put over $600,000 of my own cash into it. And as you touched on, Anthony, you don't see that type of institutional ownership on companies under 100 million.
Oh, you just don't. And that's
Anthony,
what really,
I'm gonna jump in
Yep.
just quickly. And you know, we've gone over the share roster. We love to talk about it. It's something we're very proud of. And if you look down the list, again, it's some of the biggest and most successful mining investors in the world. These investors all came in at Canadian 50 cents. The stock price now is at Canadian 52 cents. So if you buy in the market now, you're getting it at the same price as all the top mining investors in the world. And I would argue, you know, we've done a lot to advance the project since the company went public. And you got to remember, we raised the money in January, went public in May of last year. We've been trading for just under a year. And, you know, as Jason mentioned in the catalyst slide, we've done a whole heck of a lot in the last 18 months to advance both the projects, to build a real mining company. And as you can see on this slide, you know, we've really built the capital markets presence of the company. We've got 5 covering analysts. So in less than a year or 18 months, less than a year public, 18 months since existence, we've done a whole heck of a lot to build a real mining company. And then if you're buying in the market now, you're getting it at the same price that we went public at.
absolutely. And another, I think, you know, fact or I want to mention and point out is that, you know, because management has such a large position in the company that they bought in the open market, when it does come time to raise money, they're going to be very strategic about it, because obviously they don't want to dilute themselves. And you see a lot of these junior miners just flood the market with stock, and there's so much dilution. So Jason, can you talk about, you know, strategically how you would go about doing that if the time comes, if and when the time comes?
Yeah, it depends on, you know, what we're trading at and stuff like that. But there's optionality to how we can go about raising capital. Because these all have a low royalty burden, there's ability to, you know, sell a royalty, which could bring us in, you know, 10-15 million bucks, if the value is there with the royalty provider. But you know, as like I said, the largest individual shareholder other than Eric, I'm very cognizant of dilution, especially, you know, at this level when we're trading at 0.2 times NAV.
Yeah, for sure. So you added the land at Wildcat and Mountainview. You know, is it way too early to talk about how that will impact the resource base? I mean, do you have any idea of what you have underneath you know, the land there?
Yeah, so why we staked a lot of this land was, as I mentioned to you, there's 24 historical mines in the area. We're only looking at, I believe, 6 of them right in the current pit, which I've underlined. There's a bunch of prospectivity all to the north. So that's why we staked a lot of that. And the land, like I said, out here is to secure processing sites. As I mentioned to you earlier, in Nevada, we're confined right now to our NOI permit. So you only have 5 acres of disturbance. And when we bought the projects, we were sitting at 4.7 acres of disturbance. So we're quite confined. But our detailed mapping program last summer showed a lot of prospectivity up into the northwest. That will be drill ready in 2023 once we have the full exploration plan of operations, which gives us over 750 drill pads.
Yeah, that's
The staking we're doing again is thinking 2, 3, 4 years ahead. We don't want someone else to come in and strategically stake what could be prospective or strategically important land from the perspective of putting these things into production. But again, we're not, this is back to the question of, are you going to build a mining company or are you going to sell to the highest bidder? We don't have any control over that. We want to build a production company. And in order to do that, you got to think 2, 3, 4, 5 years in advance. And that's what we're doing in adding the land packages at both Wildcat and Mountainview.
How much were those land packages, by the way?
Oh, it was like $27,000. It's the cheapest
Wow.
you can do. Yeah. So just to put it in perspective for everyone, okay, we do, again, we look at 3 years down the road. So to truck the ore in electric trucks down to this pad location, as opposed to down here to this pad location, that difference saved us $40 million in operating costs and trucking. Okay. So you drive the loaded truck, electric truck down the hill. So it charges the battery, dump, it's closer and it's downhill. And then you come up the hill empty. So again, because we've done this so many times, we do things that most companies, exploration companies do 3 years down the road. We do it right now.
Yeah.
So that land that we just got was because of the haulage route cost benefit analysis that we were doing.
Yeah, and that I mean, think about the savings by just spending that little amount of money to get that kind of savings is amazing. At Wildcat, when will you be able to drill below the inferred ounces? And do you have any idea of how that might impact how that might impact your inferred ounces? Like, how will it double it? Will it grow it by 50%? I mean, I know it's kind of hard to
yeah, it depends on a lot of things, right? It depends on obviously the geotech, so how steep you can make your pit walls, and it depends on your leach kinetics to see how big we can pull, how much we can pull down the pit. What I can say is that when Allied Nevada had this project, there was 1.5 million ounces on it. Okay. So the current drill program is all these red and yellow holes that you see there. So these holes that we can drill like this, we can add these blocks and hopefully drop the pit like this.
Yeah.
Instead of having the pit like that.
Yeah, I mean, and I think
the answer is we don't know exactly what it's going to do, but we're very excited to find out. We haven't even gotten there and drilled yet. We'll be there at the end of the month, and you'll see news in the market shortly thereafter. But if you look at the entire portfolio right now, this is the asset that gets us most excited. I think this is the asset that gets both the shareholders and the analysts that cover the stock. We see significant growth potential. And again, this is all at surface, no strip. You basically just scrape the top off the mountain. It's as good as it gets.
Yeah. So at the end of the month, when you announce drill results, will it specifically be for these drill holes? on the left
No, it'll be for Mountain View.
for Mountain View. Okay.
Yeah, so there's a really interesting hole that was drilled towards the northwest, 75 meters outside of the pit. That looked really interesting. So that will be the next batch of holes. And again, we're confined to how much we can step outside of the pit because of the permit.
Mhm.
So that'll be the next batch coming from Mountain View at the end of the month. And then hopefully by the end of May, June, we'll have the first holes for Wildcat.
Wow. Yep. So it sounds like you're going to have a lot of drill results, coming out this year. A lot of catalysts, for investment. I think that, again, like I said, we look at a lot of exploration companies here at Torrey Hills Capital, and this, we think Millennial is well positioned to be arguably one of the most successful, we've seen in a long time. So I think we're going to leave it there for now. For those of you who joined, the code word for the feedback is nugget. I want to thank Jason Kosec and Jason Banducci for coming on today and bringing us up to speed on Millennial Precious Metals. Obviously, an exciting time for the company. 2022 is going to be obviously, with drill results and the PEA expected. We feel, that there's going to be a re-rating that will value the stock higher than where it is right now. And you have an opportunity to not only own the stock where, the institutions own it, but you also have an opportunity to own the stock below where management has purchased it in the open market. So I think it's an excellent situation to consider. So thanks again for coming on and bringing us this story. You have any parting words, Jason, before we wrap it up?
No, I think thanks for your listeners for joining me, and I think you're, with the wind at our back in the metal prices, what you'll see is the big guys will, start trading above 1x NAV, and then that big money will slowly cycle back. And the first place it goes is to top mining jurisdictions with existing resource base that's going to consistently grow. And these are the stories that move when that money cycles down. So thank you very much, everyone, for listening. And if you have any comments or feedback, feel free to reach out.
Yeah, thank you. And in the meantime, you can get additional information on Millennial Precious Metals at the company's website, millennialpreciousmetals.com, including details on the company's current projects, as well as the latest press releases. I want to thank all of our attendees for taking the time today to join us, and I look forward to your feedback. I will be sending out a feedback link at the conclusion of the meeting. It's very important that your feedback is very important to us. So the sooner you get it back to us, the better. So with that, we'll wrap it up. Thanks again, Jason K and Jason B, and we will safe travels to Arizona, and we will talk to you again soon. Thanks.
Thanks, everyone.
Yeah.